On the chart previous, the market is making a series of higher lows. What that means is that the lows you see at point 1, point 3, and point 5 are each higher than the previous low. Point 3 low is higher than point 1 low. Point 5 low is higher than point 3 low. This is what you see when the market is in an uptrend. You also see that point 4 is higher than point 2 and point 6 is higher than point 4. This is another sign of an uptrend. Rising highs and rising lows means this market is in an uptrend. Of course, the opposite holds true for a downtrend. A downtrend consists of a series of lower highs and lower lows. One of the challenges that new traders have is the idea of selling short the market. If the market is trending down, it would be nice to be able to make a profit from it. Well, you can if you know how to sell short the market. Selling short means you are selling something now, and you will buy it back at some point later, hopefully at a cheaper price. You pocket the difference between where you sold it and where you bought it back. Example of trend analysis. On the chart on the next page, you see a stock over many years. You should be able to see it going through phases where it is in an uptrend and phases where it is in a downtrend. Can you spot the uptrend and the downtrend? I have made it easier to see by labeling the uptrends with blue lines and downtrends with red lines. First, the market moves up, and the peaks are higher than the previous peaks. Then it changes, and the market fails to make a new high. It also makes a low, which is lower than the previous low. The market has moved from an uptrend to a downtrend. This stock was in a long-term uptrend until year 2001. In late 2001, it makes a double top, and a downtrend begins. This downtrend is visible to the trained eye because of several clues. The red line you see on the chart is a moving average, and it begins to slope downwards and the price of the stock is below the moving average. You should also see that the market continues to make lower tops and lower lows. In 2005, the market makes an attempt to move higher, and it succeeds temporarily. Then the market fails, rolls over, and the downtrend resumes. Don't for 1 second think that the market is always easy to understand, just because you know how to read a chart and understand technical analysis. That is why we use money management when we trade. We will cover that later. Some markets are very easy to analyze. The chart on the following page is easy to analyze. I am preparing a trade in the Australian dollar. The first thing I need to figure out is what the big trend is. It is easy to see that the Australian dollar against the US dollar was trending up to begin with. Then it changed. The change is also easy to see. The chart is making two tops close to each other in the middle of the chart. Then the market makes a big move lower, which goes below the last low before the highest high point you can see on the chart. Then the market begins to trade sideways, but it never makes it up to the old high. The market slowly but surely begins to trend lower. A market has moved from being in an uptrend into a downtrend. Definition of trend change. How do you decide that an uptrend is no longer in place? How do you decide that we have moved from an uptrend to a downtrend? I was taught this definition. To reverse an uptrend to a downtrend, the market must make a lower low and a lower high, and then turn down from there. Example. The chart of gold on the following page is moving up, but at point 1, the market makes a high, which is not a higher high. It is a lower high. The high at number 1 is lower than the high you see at the top of the chart. At point 2, it has made a low, which is lower than the previous low. By point 3, the downtrend has been confirmed. The moment the market begins to trade below the low at point 2, you could argue that a trend change has taken place. No, you can't. Neither can I. We can't say that the trend is up. We can't say the trend is down either. In fact, it makes most sense to say that there isn't really a trend in place. This market is called range-bound, or a ranging market. Some traders love range-bound markets. Some traders love trending markets. Some traders are good at trading both kinds of markets. Both trading disciplines have their merits. It is just a question of training and strategy and risk management.